All right, welcome, welcome. Good morning, good afternoon, good evening, wherever you're joining us from. I hope you're having a good one. My name is Jimmy Two Times. I will be your host today, and looks like we already got a couple people in here for the latest Bullet live stream, man. I love it. All right, we'll wait a couple seconds, let more of our friends get in here, but it's great to see everyone, man. We got an exciting show for you guys today. We're going to be talking about some liquidations, some Perp DEXes, and as you see, we're encouraging no sex, right, for this live stream. So anyways, we're going to get into it, and I'll just introduce our guests really quick. Some of you might be joining us for the first time, so I'm going to give Tristan a chance to introduce himself, talk about what he does. But with us, we have Trevor, a.k.a. Flip, and we have Fiddy, a.k.a. Anand from Paradex. So really excited to talk to you guys. But right now, I'm going to hand it over to Tristan, one of the co-founders of Bullet. Tell us about yourself and what you do, man.
Sounds good. I'm Tristan. Yeah, like Jimmy mentioned, one of the co-founders of Bullet. With Bullet, we're trying to build an extremely high-performance Perp exchange network extension on Solana. So trying to really solve that niche for the kind of Perps trading audience kind of hasn't quite taken off in the way that we'd hoped on Solana. And so we're trying to build like a very fast execution layer there. It's all club-based. We've been building on Solana for multiple years and doing derivatives products. Actually have kind of collaborated a bunch with Anand back in the day on the option side of things. So we've both been around the space for quite some time. And yeah, our biggest value prop is being able to do central limit order books at basically like a frequency of like, you know, every millisecond being able to settle trades, which I think is like the fastest on the market. We also have like a full-fledged like a multi-collateral cross margin engine. A bunch of other really cool features. We're going to mainnet very soon. So yeah, it's like an exciting time for us. We should be out quite soon. Not giving a deadline just yet, but it's kind of the final stretch that we're going to be out on. And yeah, it's cool to see all the hype around the Perp side reaching kind of fever pitch, I think, over the last like month or two. So yeah, looking forward to the discussion here today.
Yeah, definitely. Me too, man. Great to have you on. And I know a lot of people are very eager to get that mainnet drop date, so I know they'll be tuning in. But just in case you didn't hear, Tristan just said no date yet, but you guys will be the first to know. We'll drop it here. GM to full value. Oh, what's that? Sorry.
I'm working till midnight every night until it's shipped. So
this guy's a builder,
man. You got to be up till like 5 or 6 in the morning. What is this rookie numbers, bro? Midnights for rookies, homie.
Big GM to Full Value Dan in the chat. Thanks for joining us. And Flip, let's move over to you, man. Tell us a little bit about yourself and what you do.
Yeah, pleasure to be here. I'm a research analyst at Delphi. My background's in traditional finance, where I spent most of my time on public markets, but also spent some of my time underwriting funds, building fund of funds internally at a multifamily office, which was a lot of fun. But my passion was always crypto. And so I ended up working for a crypto hedge fund for a little bit and then quickly moved over to Delphi. Absolutely love the Delphi team, so it's been a pleasure being here. And then I love specializing or focusing on perps because I view that as like the tech sector, if you will, from Chad Fines. Like I view Perp DEXes very much so as like the tech sector, high margins, high growth businesses. And so I love spending my time to talk with founders and some of the smartest people in the space, like Tristan and Anand. So looking forward to this conversation.
Yeah, definitely. It looks like we lost Anand, but he'll come back momentarily. I'm sure he's going to join the studio again. And one thing, guys, about Flip, he is joining us from on vacation. He told me this in our green room right before the stream. He was that eager to get in on this conversation. He joined from vacation. So big thanks to you for doing it.
It's not every day you get to talk to Tristan and Anand, so you got to take advantage of it.
You do. You really do. So you're not wrong, man. You're 100% right. So Anand, we lost you for a second, but you're back. Tell us about yourself, man. Who you are, what you do.
Yeah, man. So I'm Anand or Fiddy Bips. Either one works. I co-founded Paradigm. For those who don't know what Paradigm is, we are think of us as like an institutional options exchange. We're founded in 2019. We do about $1.5 billion to $2 billion a day. We're about 35% of Deribit on any given day. So if you're on options, you probably know us. If you don't, you don't. And then a couple of years ago, we decided to we decided to start Paradex. So Paradex is a decentralized exchange. It's built on our own stack. So it's built on our own chain, which is the Paradex chain, which is an L2 that settles on Ethereum. And Paradex does between 1.2, 1.5 billion a day. We're a top 5 DEX now. We have perps, we have options, we have spot coming soon. And the value proposition for the DEX is, we have better than CEX liquidity. So you have no CEX encouraged. We have, we're also trying to get away, get users away, to move away from CEXs. We have privacy, which is a big differentiator versus most of our competitors. And then we have a unified margin. So spot, perps, options, everything from the same account. You don't have to jump pools. Multi-collateral is coming soon. So the goal is very much to kind of, create that super, you have great pricing with better than CEX liquidity. You have zero fees. That's another value proposition. And then, of course, the unified margin that unlocks capital efficiency.
Yeah, I mean, if there's going to be no CEX, you got to have something better than CEX, right?
Yeah,
so
exactly.
Obviously, man. Love it. Love to hear that, man. And I see a lot of people popping into the chat. Matrix in the house. Bulletish, of course. We are too, my bro. A lot of G dimes in here. Let's get some G bullets in the chat. What's up? Husky's in here. Pasha. All right. We got a lot of friends in here, man. Great to see you guys. If you do have a question, please drop it for the guys in the chat. But yeah, I'm going to start with my first question for you guys because obviously we've been seeing a lot of volatility lately. We had a pretty big October 11th, right? Well, in a bad way. Kind of wanted to touch on that first. I know this week we've seen some liquidations too. But talk about what happened on October 11th. And how do you guys feel that, current CEXs and DEXs actually fared during that big event? Tristan, let's start with you.
Yeah, sure. So yeah, I was unfortunately, I left on holidays. I thought I could take like 2 days off, and then knowing crypto, I went camping, and then I opened up my phone to see just like everything getting liquidated, and then I just had to like rush in and just kind of like get back in the zone. But yeah, it was quite a tumultuous period, I gotta say. A lot of assets like really wicked pretty badly. Like majors took a bit of a hit, pretty major hit actually. The biggest we've seen in a while, and some altcoins just really like dumped very hard. The wicking behavior taking some, I think like Atom and a few others to like literal zero on Binance, which was pretty insane. And yeah, there was like quite a big aftermath. Some people saying like we still haven't seen the full extent of the aftermath in terms of like, who might have like blown up in some of these situations, because I think the market was starting to take on a lot of leverage. People were kind of expecting we're going into like the full blown bull market, and I was even starting to get back into perps and like in place of a few kind of like highly leveraged trades that I got blown out on. But yeah, it was like interesting. I mean, especially for me, like I trade less intraday and more just like focus on building our exchange. So just seeing this as kind of like a test of these kind of risk systems, especially on the DeFi side of things. I think it's been interesting with like so many people shipping like perps exchanges to mainnet in the last couple of months and like the frenzy around that. I think we did see like some blowout effects on like some of the major exchanges. Like Lido went down for 5 hours. Some other exchanges had to do like big user compensation plans, which I think were like quite controversial. So it kind of points to the fact that like this isn't spot trading where like things are kind of there's no like inherent like leverage in the system. Like these things are pretty complex systems, and there is like risk involved, and like the exchange can go under if it doesn't have the right risk measures. And I think this is definitely like a wake up call to a lot of people who haven't thought like hard enough about their risk engine. And I think it was pretty interesting as well, just from the perspective of centralized exchanges. Like I think Binance actually took the brunt of the blow. From what I understand, reading some of the postmortems, it seems like there was kind of there was kind of an oversight in, I guess, how they did some of their like mark pricing, essentially like referencing their own internal spot order books as opposed to like what the global reference price would be across multiple exchanges. So you saw like a major dislocation in Binance and like wicking much harder than every other exchange. I think that's also interesting because like that was probably a reasonable assumption that Binance made like as of like 2 years ago, where they were the dominant liquidity source. But it's really cool to see like Hyperliquid and like a bunch of other on-chain sources with potentially hundreds of millions or billions of dollars of liquidity actually like quite important to read into and factor into that pricing algorithm. And yeah, I think definitely some like anti-centralized exchange Binance sentiment after that, from people getting ADL pretty hard or losing money and stuff like that. So, it definitely shows that we have some way to go in terms of building better exchanges. We're not through it yet. And yeah, like that's why I think it's like a good wake up call to build more resilient, more robust systems. But I think it has been cool once again compared to the FTX liquidation event, where like DeFi actually held up really well because it decided to margin call or it decided to liquidate people on Aave and stuff like that at the point that they should have been liquidated, rather than centralized creditors. I think kind of just like, it's kind of like a trust me bro thing, where you have these kind of bespoke off-chain agreements, and you're not going to kind of, you kind of, the contagion goes out of control. DeFi, everything is fairly systematic and codified, which I think is nice. And even though Hyperliquid had controversy around the ADL stuff, like the exchange refuses to get killed, and like despite all the things that have been thrown at it, it still kind of like has its head up and is still seemingly doing pretty well. And yeah, I'm sure we'll talk about ADL versus no ADL in future. But I think it's interesting.
I think that's a great point, because it's like exchanges they've like, 3 core things that they need to run. They need to focus on. Is like, you need solvency, you need liquidity, and you need uptime. And it's like ADL and or socialized losses, helps with the solvency side. So I think this is like a good question for Anand, just because they were live during, and I'm sure Tristan, you got to see a ton, even though you were just in testnet. It's like, Anand, like, how did you guys handle this? I mean, so like, what do you think about ADL? What do you think about socialized losses? How did Paradex hold up? Where do you think the industry needs to go managing this type of risk going forward? I mean, this is a question for both of you guys. It's like, how do we go about managing this going forward? Is ADL like, is it the end state of risk management for these guys? Is it RFQ? What is it?
Yeah, I mean, that was going to be my next question anyway. So let's go. You read my mind, man.
I think Black Friday, and like just taking a step back, right? I mean, outside of all kind of like the carnage that happened kind of downstream, I think it's kind of like important to talk about like what happened, right? Of course, there's like leverage in the system, and like, yes, people leveraged, up to their tits. Like it was nuts, right? But I think a lot of what happened at Binance had a lot to do with, how much worse it became. And it's very evident, and of course, I don't exactly know, so this is speculation, right? But like, there's enough smart people talking about on Twitter now that are saying that like, if anything, the one thing that is the direct result of Black Friday is that there's the trust that you had in centralized exchanges is kind of like eroded, right? Because yes, they compensated people, yes, they moved really quickly to get make people whole, etc. But like, where's the accountability, right? Like, where's the postmortem on what happened? There seems to be so many things that went wrong, right? It wasn't just like, from what I can tell, it's an API issue, it's a mark price issue, it's a bunch of different things. And of course, ADL did kick in, but ADL typically kicks in when the insurance fund is zero, and Binance's insurance fund was not zero. It just dropped by a couple $100 million, and then ADL kicked in. So, and again, I don't find documentation. Of course, maybe they have it, maybe you haven't seen, right? I'm not throwing stones at anyone, but like, I think the lack of transparency and and the post incident kind of like lack of accountability in terms of like, hey, this is what happened, it won't happen again. By the way, this is like by default for DEXs, right? Anything happens, the community is like fucking at our throats, right? And that's a good thing. That's a good thing. We're dealing with people's money. Remember that, right? We have $100 million in our bridge. And that is responsibility, right? And like, I understand this idea that like, yes, it does get frustrating at times if people are like pushing you, but it's the right reaction. People in some sense need to be irrational about dealing, if they're upset about their money or we've lost money in some way, we have a really deep sense of accountability to that, right? So if we can do that, then why can't the centralized exchanges do that, right? And so I think at a minimum, that question is now top of mind for everybody. And, I don't think we go back. And, by the way, I mean, we're all beneficiaries here of the great migration from centralized exchanges to decentralized exchanges, because most people want to move on chain, right? This was a movement, that was happening anyways, right? Perp DEX season, et cetera, but incidents like this are just such powerful catalysts that like, when there is a secular trend that's already on its way, and then you have these like Minsky moments that you have this one thing that all of a sudden makes something that was 1x now becomes 10x faster, simply because this one catalyst happened, right? So I think before we get into the details of all that, I think that the one thing that stood out for me is, wow, this was like this was served up to us as like DEX founders. This is like amazing, right? So Perp DEX season was anyways like a good thing. There's like a great re-rating of volumes, a great rating of valuations and stuff all across the board. But this single event, I think, has done more for DEXs than anybody could have done. Like, there's no pitch that Tristan and I could have put out that could have convinced you that, like, hey, building on chain is better, right? Even all the issues with ADL, whatever that happened, it still fucking worked, and everybody still knew what the fuck happened. And that's an amazing thing, and that's where DeFi really shines, right? So I think it's easy to forget what happened, but to me, I'm like, man, this is our chance, right? It's like, it's go time, right? Like, if there's any time like that an opportunity has been served up to you, now's our time to swing.
Dude, let me just say, hey, fucking men. That was awesome.
Man.
That's going to be a viral clip right there. I'll just, fucking chat. Let's give it up for that one. I love it. Chat, remember, if you got questions, please drop them in here. We're live with Tristan, Flip, and Fiddy Bips talking no sex, Perp DEX revolution. All right. So all that being said, Tristan, if Bullet were live during that event, what would have been how would Bullet have dealt with that?
Yeah, really good question. We did have it on testnet, so everything was kind of simulated in a sense. I can be pretty honest here. I would say, thankfully, from the chain congestion, scalability, uptime perspective that Trevor kind of mentioned, we did incredibly well there, which is great. I will caveat that saying, yes, it's testnet. There's not 100,000 real users there, but we did have a ton of open positions, and we did have market makers running that whole time essentially. And we have spent so much time on just DevOps and making sure that everything kind of works. And the fact that we've been in testnet for a couple of months, we've caught a bunch of these bugs and really tried to iron out to 99.9% uptime. So the really nice thing was, in the past, we were built on the L1 with Zeta, in these kind of market events. L1 would get congested. It'd be very hard to send through transactions. I'm pretty sure, having talked to some market makers on other platforms like Drift, essentially they could not cancel orders or close out of positions that entire time, which is pretty rough. So you end up just holding onto massive deltas, which is a difficult spot to be in. So from that kind of pure tech perspective of the chain worked, we didn't have a database go down, everything kind of worked through that time, even though we processed thousands of kind of orders per second, which is really nice. That being said, I had written some basic liquidator bots essentially to run on our platform, and I just done them in a very quick way. We're obviously going to do this much better way for production, but it was just to have something running, and those are a bit too slow. And I kind of made the assumption with those things that I was oh, we'll rescan all the accounts and check liquidations every 2 minutes is fine. That shouldn't be a problem. People can't move from 0% liquidatable to 100% in 2 minutes. That would never happen, right? How naive I was. We literally went and looked through the logs, and people were at 95% margin health, and they dropped to 0 within literally a minute. It was insane during that 2 minute interval that everything kind of wicked, because a bunch of these people will have smaller but very high leverage positions. And so definitely it was a little bit of a theoretical drawdown on the insurance fund there, but that was great that we just have a data point now that we can go through, analyze it. We've already fixed the liquidator up to be much better. We're going to rewrite it in Rust and just speed it up a bunch. So small things like that. I think it was nice that we had some learnings and things to kind of bulletproof in the system. And thankfully, no money was obviously lost. But this is a big focus for us, and has led to tiny bit of minor delay in mainnet, because I want to get our devs and quants sitting down and looking through this as a use case. Because I think it was great for Paradex and a bunch of others. They got this live example, this live data point that they can kind of fix things. And for us, I don't want this to be a wasted opportunity. I want to use all the learnings of this to kind of be more mainnet ready. So
built right, bullet right, would you say?
Yeah, I guess so.
There we go. I love it, man. Do you guys have any, I had a buddy who was, I don't have a life, so I was just hanging out watching everything drop. But I had a buddy who was talking about, he was on his way to take his parents to a fancy dinner after having a solid year. And then he's in the Uber on the way to the fancy restaurant, looks at his phone and sees the big event. What were you guys doing when everything went down?
Yeah.
I was. Yeah, go ahead.
I was firefighting, bro. It was not a fun day.
Yeah, you were. Yes, you were firefighting.
It was not a fun day. I mean, it's it's crazy that so lucky for us, we didn't have any socialized loss. We're actually probably one of the few exchanges, or the only exchange that actually didn't have that. our insurance fund actually ended up making 600K. So, depositors were pretty happy. Of course, the exchange, was slow for, a good hour and a half or something like that. But overall, we were super lucky that, nothing major happened, right? And even the tickets and stuff, we had a bunch of tickets, but we cleared them within the, I think within the first 2 days or 3 days, we cleared 51% of the tickets. And then within 5 days or 6 days, we had 90% of the tickets done. So nothing crazy, but the crazy thing is we had a bigger, although Black Friday was a kind of an event for everybody, we had a bigger event, incident 2 weeks before that. And the fixes from that really helped on Black Friday. And literally it was a week and a half apart. And that by far was, far more serious for us. And if we hadn't fixed that, it would have been way, way worse. So it's just, again, I tell the guys internally that man, you don't get 2 second chances in crypto, right? If you don't, if the market tells you something and the market serves something up to you, bad, good or bad, and you don't price that into the next time, you do something, then there's nobody else to blame. And, kudos to the team. They fucking reacted really fast and we fixed things really quickly. Otherwise it would have been, a lot worse. So again, it's one of those things, we got lucky, unlucky, but lucky. At the
right. No, that's it. And you're dropping, totally. You're dropping science on them too. Yeah. Sorry, go ahead. I didn't mean to interrupt. No,
it's just like I was saying. So I think, I woke up to the carnage and the team was already up and, I think we got on a call. I mean, the team was already on a call. I jumped on the call. I think that was at 8 or 9. And, the call didn't end until 3:30 just to make sure that the system was all, everything was good. We're not not seeing something. And by 3 o'clock, we were back to normal operations. We had pause gigavault deposits and withdrawals just to make sure that the accounting in the system was clean and make sure that we're not incorrectly liquidating users that are, but most of that, and then we resumed it, soon after. But then we had another call at 9, that's as we have this internal drill that if something bad happens, you first meet, but then you kind of let time pass and then you meet again just to make sure you're again. But then by 10 o'clock when we had jumped on another call, most things were fine. But again, you're paranoid, right? So I don't think I slept that first 24 hours because we've just, because you can never be sure, right? I feel guilty closing my eyes sometimes because I'm fuck, I'm not watching to make sure. It's because it's people's money at the end of the day, right?
Yeah.
Fine. It's fuck, if I don't sleep for a couple hours, what the fuck, but if I could have slept a little bit, not slept a little bit and prevented something, I think that's much better. So
okay, so to everybody watching this and everybody in the chat, this is what you want to hear from founders, just to make it clear, all right, when there's events like this. So Flip, what about you, man? What was going on in your world?
Yeah, I mean, I can talk about what's going on in my world. And it wasn't nothing too exciting. I got liquidated.
He was on vacation, bro.
Yeah, no, I wish. No, I was not on vacation. I was at home.
Kidding.
I was working. I just remember looking over and getting alerts that my account had been liquidated on whatever 1.7x net leverage, which I mean I think is what it is, but it nothing special. But the thing that really stood out to me is how well DeFi held up.
Totally.
And the Lindy effects that the Perp DEXes that are live today and those in testnet that we're paying close attention will have, I think the Lindy effects will be massive, even for things like Hyperliquid Lighter, Paradex, and these others that are live today. I think the Lindy effects there are quite strong, and that trust that you have with the users that hey, you guys stayed solvent, you guys had good uptime, you told us what happened. We don't have to we don't have to speculate behind what's behind the curtain. You tell us. I think those Lindy effects and the trust that's been built over the last 2-3 weeks is massive for these teams, and that's what I'm most excited about. Because, and also I think the debate that's happening right now on Twitter regarding ADL and socialized losses and the pros and cons there are quite huge, and I think they need to be discussed more, because I think that's quite huge and needs to be considered and understood by all market participants.
Yeah, so where is everybody? I mean, I think that probably we've gotten an idea thus far, but for those who are just joining us, where are we at? Where are you guys at as far as ADL and socialized losses go?
I wrote a pretty damning post about it, but I'll let Tristan go first because I have a very strong opinion about it.
I mean, you're spitting fire today anyway, man. So let us know.
Yeah, Anand's post was definitely good, and I like his text. Like, I'll probably respectfully disagree with him because we kind of have ADL, and I think it's like a really good way to kind of preserve that invariant that like the exchange stays solvent throughout like all conditions. Essentially, like that's pretty important for us. Is like crypto is a survival game. You know, if we blow up or any exchange blows up, that's kind of like it's done at that point. So like my kind of bottom line is like need to do whatever we can to kind of keep things alive. And even if there has to be kind of like haircuts and like some people are unhappy, it's obviously like not a great user experience, but like we do need to stay alive. And like that's the massive long-term thing is like this thing needs to survive years into the future and make users whole. I think it is like a scary proposition if you are socializing losses. Like we have seen it for other exchanges like Drift, where I think Luna went to zero and basically like the market never bounces back. Like this asset goes to zero. And all those people like the kind of like P&L accounting, I think came out like pretty bad there. That the exchange was basically on the other side of like massive deltas and just basically went underwater. I remember what the number was, but it was, in the tens of millions of kind of bankruptcy debt, which is like pretty bad. And like, I think for us, that would be like an extremely tough position to be in. So to the extent that we can avoid that, I think that would be ideal. I definitely know that like, maybe ADL is becoming an antiquated thing. It obviously came out many years ago and probably hasn't been innovated on to the extent that it should be. And, maybe there are new designs that need to be coming out. It also happens to be that a lot of ADL systems, I think, are like fairly complicated and like nebulous, like not very transparent systems. So, I definitely want to put more effort into our one. Our one is, I wouldn't say simplistic, but like in line with centralized exchanges, and it does work as it has for Hyperliquid and a bunch of other platforms. But I think over time, those things and the heuristics that are used at least can be tweaked. And if people do come up with a much better like general model, I think that's something we would be very much open to adopting. But yeah, I'll hand it over to Anand because he's definitely the.
So I think it's like my argument is not so much that ADL doesn't work, as much as there is a better solution to it. ADL works because it's a very crude system, right? If you think about what ADL does, it's got two functions, right? One is solvency, right? So I mean, if you think about this, taking a step back a second, right? When the insurance fund takes over an account, it is usually has some maintenance margin in it, right? And you basically you can think of the maintenance margin as like the cost that the insurance fund has to bear to get out of the position for slippage or whatever, right? Now, over time, like if you think about the traditional exchange design, insurance funds were designed to keep taking these positions down and then building up like a reserve through these liquidations. On average are profitable, right? Because you take this maintenance margin over, you trade out of it, and whatever is balanced, you keep it in the insurance fund. It's like a rainy day fund. So that's hence the term insurance, so that in the future, there may become a time when you take over a position, and by the time you take over the position, the equity in the account is basically negative, right? It basically that means your account is bankrupt, where the collateral is not enough to justify the negative P&L. And so this is called a bankrupt account. And so at that point, the insurance fund takes over the account. The account is already negative. And then it says, oh, you know what? This account is negative. I need to trade out of this account. I need some cash. Let me go dip into this insurance fund that I have, right? Which I've built up over time. Now, most crypto exchange, at least in DEXs, we basically we give this yield back to the depositors, basically, through like a liquidation vault or something like that, right? That doesn't really change the design too much, because even in that, you can figure it out. But my point there is that normally, once the insurance fund takes it over, it tries to get out. There's not enough money, it dips into the insurance fund. And only when the insurance fund does not have money enough, then things like ADL are triggered, right? Now, when ADL is triggered, what is the insurance fund trying to do, basically, right? It is first, there's a solvency angle to it because the account is bankrupt, or let's say the sum total of all accounts that it's running, for whatever reason, have negative equity during times of stress. That tends to happen. So you have this like solvency problem. The exchange is now underwater because there's some of the collateral available, and the negative, account equity is basically it's not equal, and so you're basically insolvent at that case. But it also has this bad position that is on, and as long as prices keep moving the other way, that position is going to keep going deeper, out the kind of like worse for you from a P&L perspective, right? So you have a bad position that could keep going worse, and you're already insolvent. When ADL is triggered, that's what ADL is trying to do. It is trying to first basically get solvent again. And the way it does that, it says, okay, all you profitable traders, I'm going to close you out and I'm going to take some of your profits. So that solves my, my solvency problem through these like clawbacks. And two is it's using these same traders. It's basically saying, you're the opposite side of my trade. I'm going to close out this bad position. So it solves both problems, right? ADL does both things together in one action, right? My argument is not that we don't need both these actions. I'm saying if you separate these two functions out, socialized loss only solves the solvency problem. We have a second mechanism, which is the last resort mechanism, which also performs this last resort closeout with profitable traders. The only difference being in both mechanisms, socialized loss and ADL and last resort, you have predictability. Right? In ADL, you have no predictability. If let's say I'm Athena, brought up a great, people talked about Athena, etc. Athena is a great case. If I'm long perps or short perps on a particular exchange and I'm long spot somewhere else, and now you close me out via ADL, I have a fucking unhedged position for billions of dollars. And I don't know about it. You just did it. Right? So the lack of predictability is a fucking huge problem with ADL. With socialized loss and LR, last resort, we separated these two functions out. You're still performing the two functions that ADL does. You're just doing it kind of separately as two asynchronous processes, and you introduce time. And because you introduce time, it also allows liquidity and solvency to kind of recover, right? So, it's not so much as like ADL doesn't do what it's supposed to do. We just think a more elegant design and a better user experience is you take the two things that ADL does. It's kind of like the modular way of thinking, right? If one thing is doing two things, you separate out into two processes, and it's much more efficient now, and it can operate kind of asynchronously, right? And if you introduce time, it allows liquidity and solvency to heal. So it is functionally a much, much more better approach. It doesn't break your hedges, so you don't have this Athena problem. There's another problem that most people don't appreciate. Now, this is all in the weeds, kind of like nerdy infrastructure shit, right? This is a simple example that I think most people can understand. Now, imagine, let's say, Jimmy, two times. You have a portfolio, you're long a bunch of Bitcoin, and you're short, a bunch of like shit coins, right? And your Bitcoin position is super profitable, right? But your alts, all your alts are shitters. They're like, let's say they're, super negative, right? But in a cross-margin account, your profitable Bitcoin position is offsetting the P&L from that is offsetting the losses from your shitcoin positions, such that your account is still healthy, right? Now, if the exchange comes along and says, "Oh, you know what, Jimmy, two times, you're a profitable Bitcoin trader. I need to close you out because I have these unhealthy accounts, these bankrupt accounts. I need to close out," and I close you out. What happens is the rest of your positions get liquidated. Because now the profitable position that was holding these unprofitable positions, above water, now become basically your account becomes unhealthy. And so this breaks hedges, not just, inter-exchange, but also within the exchange itself. And there's no guarantee that you can actually find counterparties that are both profitable and don't trigger more liquidations that come after. So it is like, it's just for all of these reasons, it is just not a good idea to do both these things in one action. It's much better to separate them out and just do them as two separate processes.
But my question is, how did you know all this about my portfolio? We just met, right?
you just look like you're long BTC and you're short shitcoins. Well, you have that face.
Exactly.
I think the one huge unlock there, though, for like that architecture is like the time component, the optionality that users have. Like, I think that's quite interesting. It's like, yes, it's socialized, but like that, that's not like permanent loss. Like you can get that back.
Yeah,
like,
you
get that essentially rebated.
That's a fantastic point. A lot of the times you're closing out these positions at the time of the most amount of stress. And you're not allowing the market to recover. And so you crystallize losses or profits, whichever way, at like the worst time profit possible. But if you allow time, and liquidity will recover, solvency will recover, and eventually, you'll be able to do this out you will perform the same functions, but in a much more predictable way. And it's like a way like better taste for customers than the very crude approach to ADL. ADL, was inherited from BitMEX. BitMEX, when it had isolated margin, they didn't have these cross-margin portfolio margin systems. And so again, I just feel like it's a relic from, from the Stone Age, and like nobody thought to take it over and be like, yo, this doesn't work for our use case. Let's fucking innovate on it and make it better. Like nobody did that. They just implemented it, as is.
Yeah, and I guess the one big risk there is, or the risk that the user has to understand is like, okay, I'm taking on this time component and this risk of socialized losses. So the platform could go, insolvent quicker than someone with ADL, maybe, or no, or these, relatively similar. Like, so like I can get ADL'd on a position, but the exchange could go insolvent, or like the platform could go insolvent. And if it's self-custodial, I'll still keep my assets, but whatever positions I had on are gone. Like, what are those trade-offs there? Are those pretty much
you're not like, to me, there's no trade-offs, because if you separate these two things out, you're still performing both functions. So it's, it just happens in a way in which you never have to break your hedges. So the trade-offs are, there's no trade-offs. It's a better solution. You're going from either I don't need to break my hedges or I do need to break my hedges. Which platform do I choose? And so to me, like, the choice is clear. And I think once people see this, or they'll see it like operate in a good way on platforms like us, I think more people would adopt it. It's only a matter of time.
I think what's really cool about what's happening right now is we have a really good conversation happening on the stream, and we have a good conversation happening in the chat. So shout out to everybody participating right now. It's really cool to see.
We can't see the chat, bro. Where do you? Oh, comments. Oh, never mind. I see
comments. There you go. Yeah. Someone. Oh, go ahead. Go ahead.
Really appreciate the explanation on that. I think that's like a good point, like piecing or like kind of separating out the two functions. I'm kind of curious, like what's your criteria for that last resort, essentially like closing of positions? Like how much time do you, or like what are the heuristics that you're using after the kind of socialization of the loss?
Yeah, I mean, obviously it's you want to do it ASAP, right? Mm-hmm. So, but the nice thing is, like, okay, let's say this event happens. Because you separate these two things out, if you think about what happens, the solvency piece is now taken care of by anybody that's trying to withdraw gets a haircut. So you don't have to worry about, if I don't close this position out now, I'm going to be insolvent. Like, that risk is not there anymore, because it's kind of operating, this socialized loss is taking care of that. So it reduces the pressure on you to close out the position like instantly, right? So maybe we give it a few hours, maybe we give it like 6 hours or 10 hours, but we can communicate to customers clearly. So, hey, you are one of, X accounts, and we can, again, choose the same way ADL kind of like shortlist which account. We can do the same thing, and we can target these users and say, hey, this is happening in 6 hours. Go, unwind your hedges, do whatever you need to do, and then we close you out, or like just basically communicate, because then they have a way to say, okay, cool, that works for us.
Gotcha, that makes sense. Yeah, I think that's like interesting. Definitely, like the big disadvantage that people pointed out was obviously the breaking of these hedges cross exchanges. And then I think Anand brings up a very good point, actually, that it's in a cross margin scenario, you will have some kind of winning positions offsetting the P&L of some of your losing positions, and kind of breaking that flow essentially like breaks the kind of the hedging symmetry that you might have. Curious, like what happens, to be a devil's advocate, in the situations where like prices continue to free fall, and like if you were to have stopped out those positions like as soon as possible, like people would still, like the platform wouldn't have gone into like further debt. For example, like Luna being one of these examples of an asset literally going to zero.
Yeah, I mean, look, there's always that risk, right? But like, you don't have the solvency, again, because we're separating it out. The socialized loss will always take care. So even if the platform, even if these accounts, keep going more and more underwater, all will happen is the socialized loss factor will keep increasing. So it's not like the exchange is going to go under because of that, right? So the socialized loss factor just gets more and more. And of course, we're trying to, solve for the balance of making sure we don't want too much of a haircut, on the socialized loss, while also trying to give people predictability on closing out their position. So it's a balance, right? But it's not something we've not done before. Like, we understand how to do these things. So it's a much more easier and elegant like solution to like, versus just close out. You wake up and like, fuck, like, oh shit, now I got to deal with all this other. Like, imagine you run billions of dollars. You're fucked. What are you going to do?
Yeah, that's a good point. Yeah, that lack of predictability definitely very tough for people running like complex portfolios.
And by the way, one more point: this doesn't work for options. So because options runs portfolio margin, so it's like take cross margin and you make it like, it's like the extreme case where you're solving for capital efficiency. So the more complicated the asset, it gets like worse and worse and worse. Like this absolutely does not work. That's why Deribit doesn't have ADL. They also have socialized loss.
Yeah, I think it's interesting when like does it add to the sell pressure, I guess. Like usually when one of these weeks happen, we tend to see liquidation cascades. They tend to like even amplify the effects of what would otherwise be happening. So having these kind of like breaks on the system, essentially, I think to give it time to recover and to bounce back, and for people to log on and top up liquidity, I think generally these mechanisms tend to be pretty good. Curious as well, Anand, what are your thoughts on partial liquidations? Because I think that was something that also kind of copped a little bit of flack.
We have partial liquidation. We think it's a great idea, right? Like it's on the side of the user and the customer, right? Like you want to take as little as possible from the account to get the account back, above water, right? And why? Because then the user can keep trading, right? And remediate their the goal. Like we have this philosophy that like we want to take the least amount of actions on our part to keep the customer, so that basically to keep the control in the customer's and the user's hands, right? Because if we are like kind of like forcibly taking actions on their behalf, then like that's just a very unpleasant experience, right? Overall, of course we can do it, and that means we're like us first and customer second. And so like again, I think this is just a design philosophy with it, and that's why partial liquidations, I like it so much. Is again, it's basically it's the same spirit where we're trying to do the least amount of things to get the account, to get it healthy again. And of course, then the user, continues to have control, because once the account is taken over, the users they just wait, right? It's just like, oh fuck, I got liquidated. So,
yeah.
I gotta say, guys, this is one of those big brain moments. This is what I call them, when I feel like I get smarter just by listening to a conversation between two founders. So thank you for this. This is awesome. Guys, remember, if you have any questions, drop them in the chat for us. I do see a lot of healthy conversation in the chat, so shout out to everybody hanging out today. I do want to talk about the no CEX movement, right? We've been seeing a lot of this. I guess one of the biggest hyper liquid bulls, Smartest Money, currently a big advocate of no CEX. Obviously, what we've been talking about, transparency is the key for DEXs, and that's why people are moving over. But how do you see this kind of culminating? Do you see another event like this being needed for more people to come over to DeFi, or what are you guys' thoughts?
Yeah, I think similar to Anand, I think like we've already had certain like hallmark events over the last couple of years. Like obviously the last one in recent memory for me was obviously the FTX collapse, and like what happened there, and it kind of really solidified to me like how important self-custody was, and like everyone I think kind of forgot about the not your keys, not your coins type idea. And then now I think with this, it's like forcing more transparency into like how do these like complicated systems work in the back end, and like the lack of accountability for some of these systems I think is like pretty important. So I think like the more of this that happen, it obviously continues to break trust in centralized opaque systems. And I think that's just like a net good thing for traders and like end consumers, which is great. And I think it's also kind of like Anand said, like rallied up a bit of a DeFi movement. Like this is like a really good time to be pushing for DeFi. Like there are so many clear advantages to it. And the thing I'm excited about is like the tech stack is getting so much better, that performance is getting very similar. Like a lot of like the risk systems and things that we're able to build on chain, I think fundamentally can be done now, which weren't possible back in the day. And like DeFi always felt like this downgrade. You have to build very simplified contracts. They take a lot of shortcuts. There's all kinds of like corners that have been cut, and I think that's like starting to like not become the case anymore, which I think is very exciting. Like people are fully adopting DEXs as their like primary trading venue. I mean, like I don't trade much on centralized exchanges anymore. I hold all my money on chain with my ledger. I like deposit into different lending protocols. I trade on chain on my platform and others. So I think it's kind of good that like you can kind of make DeFi your main now, which is kind of cool. And yeah, I think like definitely have centralized exchanges to thank for back in the day for starting this whole movement, bringing so many people into crypto and like providing that service. But I think it has kind of fallen short of like the original Satoshi vision of like you build this decentralized system, it's secured by cryptography, things are transparent and verifiable, and then we've kind of gone and built like AWS based systems around that like handle and transfer crypto assets and kind of go against like all the principles of crypto. And I think that's why DeFi is cool, is like let's actually use the chain to transact the blockchain assets, like the crypto assets. So it's moved from just cryptocurrencies to now like an actual decentralized, financial system, which I think is like why I got into the space and why many other people got into the space. So yeah, I think it's good. We'll continue seeing market share. There's probably, both will exist for some period of time, but I think it's really cool. Yeah, especially seeing these guys like Smartest Money, who I remember back in his like bio was saying he was like, top Binance trader, and now he's like a .hl. So I think it's good. Like the more of these big guys who are getting into it, they're going to bring a bunch of their friends who are also like well capitalized and trading. And yeah, it's like, as Anand can probably like say, like a couple of years ago when we like started out building DeFi stuff, like there was a big hesitation, especially from institutions to come in because they're like smart contract risk and these things are like not very lindy. They haven't been out for like a long part of time. And like, how are we going to like navigate all these compliance hurdles? And like, how am I going to get people from my team to come and trade on here? Conversation is very different now. All the big guys are trying to get in on it because they know DeFi is like the next thing. And it's like natural evolution. And like people are almost like, the people are jumping at the fact that they want to get into DeFi. And it's no longer a conversation that I have to have of like, do you want to integrate? Do you want to work with us? It's like, no, it's like an obvious yes. Like, people are wanting to get in and it's just kind of like, point me to the API docs. Like just get me on there. Give me an invite code. I want to get in. So I think that's like really good to see that barrier to entry is like always dropping.
Definitely, man. Love
like,
that.
One of the things I think, catalysts aside, if you think about like we talked about the great CEX DEX migration, right? Which is more people want to be on chain, in generally, and all these catalysts obviously make things they accelerate these kind of secular trends you're seeing. But like even outside of that, right? If you think about like what is happening in the world, like in our world today, the movement that I guess we all are championing in a sense is basically like it's the logical next step for the evolution of software, right? If you think about software was invented, 70, 80, 90 years ago, something like that. And it made the cost of operations so cheap. So naturally, the first things that moved to the software world was like calculators and simple things like tasks, right? Those tasks then moved to functions like accounting when computers came about and people started doing accounting. Then as the internet came about, then you saw entire businesses moving online. With blockchains are basically, the way I think about it, blockchains are like the infrastructure for not just the businesses to move on chain, but the entire economy to move on chain, right? And so the physical economy that has operated on Web 2 rails now gets a chance to be basically, natively move on chain. And if you think about, okay, so if this is happening, and I think most people can agree with this thesis that the internet, you can see, people talk about the internet economy. It's basically just this thing that I'm talking about, which is the physical economy moving, to these like on-chain rails, Ethereum or whatever L1, is kind of like of your choosing. But if this is happening, then the one thing, like, what do economies need, right? They need financial centers, right? Wall Street was needed for America to be the superpower that it is today. Without deep liquid capital markets, America would be very difficult for America to be, what it is. And so if you think about what Perp DEXes are it's kind of like the sum total of all these financial primitives, which is, banks, brokerages, clearinghouses, custodians, everything, but combined into one entity. So it's not so much as like, oh, are people moving on chain? Of course, that's like the very visible thing. But like the thing people are not paying attention to is that the internet economy is being built. This economy is going to need, financial centers, and like Perp DEXes are literally these financial super centers. And so that's why the pie is so big, and that's why it's so fucking exciting for all of us, because we're saying, look, we want to be, the Londons or the New Yorks of the world, right? And this is your one chance to do it, right? So people will, and then once these financial centers are more fully built, businesses will move on chain to start accessing these markets. They will start issuing securities. They will borrow land. They will invest. And basically what you're seeing in the physical world will now move on chain, right? This is a fucking exciting, like I'm super excited about this. Like our team we're massively excited about this.
Yeah, we all talk about, Perp DEX is kind of becoming like prime brokers, but it's much bigger than that. And as we've talked about it on before, it's like you're gonna, and like from a business standpoint, you're gonna have trading revenues. Like like everyone talks about hyperliquid, but you're also gonna have tokenized asset management, i.e. vaults. You're gonna have a native stable coin that you're gonna, it's like on-chain Athena. And then you're gonna have bridge deposit, which is like net interest margin for banks and things like that. And then you're gonna have integrated money markets, and then social, all this other thing is like built on top of these perp dexes. Like it's much bigger than just a prime broker. And I think you just laid out a fantastic thesis.
I was having a conversation with someone right just before this call, and like I was like, look, the easiest way to explain this to you is like, think of, all the banks in the world, all the exchanges in the world, CME, NASDAQ, whatever you want, all the clearinghouses in the world, LSE, London Clearinghouse, whatever, all the brokerages, all the custodians. The TAM of all these businesses is what the TAM of Perp DEXes is. Like, we're not talking in the billions. Like, these entities can play for trillions, right? Like, it's insane, like how big the TAM is. So if you think, people say, oh, hyperliquid is like 50 billion. I'm like, you're not bullish enough. Like, this can be, and there's enough space for more people because the TAM is so fucking big. There's enough space for more people, and we can all carve out a little piece. Of course, I want to be number one, but like, is there enough space? Absolutely, there is.
I got to tell you guys, this conversation, I know I keep saying this stuff, so forgive me for just being super bullish, but goddamn, like spitting truth, spitting fire, like this whole conversation has got me hyped and bullish. Let's fucking go. Hi, chat. How are you guys feeling? Is this getting you as hyped as it's getting me? Because I'm maybe it's just the espresso speaking, but goddamn. All right.
Yeah, and like again on the business side, these all of a sudden these businesses become a lot less cyclical. Then, like we all want to talk about crypto cycles, but when these businesses aren't as cyclical and they actually like they've these massive structural tailwinds. You hit these huge bull markets. Yeah, you're going to have up and down, but it's a structural and it's no longer cyclical. Like the business model is no longer cyclical, and that's what I'm most excited about. It's like, okay, you can buy some. Don't buy any of these assets, but you can buy some of these assets and you can have great confidence. Like these businesses will generate revenue in more than one way. Yes, they'll still have cycles, but like it's a massive structural cycle up and to the right, which is incredible, and it's where we're heading.
Oh yeah. Guys, do you have a couple minutes to go past the hour? Because I want to keep the conversation going if you can, but if you got to go, I get it. So chat, stick with us. We're gonna keep it rolling. I got a couple more questions for these guys, and we definitely want to get some more perspectives. So and shout out to Quanticle for roasting me in the chat. I see you, bro. So let's talk about trading fees for a little bit. How do you guys feel about the zero fee model? Do you feel like that's sustainable?
I mean, I'm zero fees. I'm putting my money where my mouth is, bro. So yeah, of course. I'll let Tristan go first. Yeah.
All right. Well, that's fair. I mean, do you think that's where everybody's going though?
Yeah. I mean, I would let Anand go ahead.
Go for it.
Yeah. I mean, I think a lot of people think it's not sustainable, but they also haven't looked into how the business is run and how you generate revenue. And it all comes down to, you've got market makers, you've got users. And like you make revenue somewhere in there, and it's like generally speaking, I call it taxing the users. I mean, most of these users they lose money anyway, so it's like kind of who cares. But it's like, okay, if you could all of a sudden charge the market maker to pay for flow, it's like, okay, well, how do you get the market maker to pay for flow? It's like you have to have really curated, benign flow that they know they're always going to win that trade, and it's a profitable trade for them. And so like you really do have to segment flow in some way. Like Lighter is doing it via latency speed bumps. Paradex is doing it via RPI and actual like flow segmentation, like UI and API. And I think it's quite interesting. And the market makers I talked to actually really enjoy it as well. Not a lot of non-hit it, but I think it's definitely I think it's robust, and I think it's where we go. I think we go zero spread, zero fees.
Full value dances, LOL fees, good or bad. Hey, man, give the host a break, man. I'm just trying to start the conversation, my guy. Anyway, awesome. Love to hear it. Let's see here. All right, so let's talk about HIP3 was also released for Hyperliquid, allowing any kinds of market to be traded on perps, such as equities and prediction markets. Do you agree with the term perpify everything? What are the most exciting markets we want to see on perps?
Wait, who
Anyone?
asked? Oh, okay.
I'm asking the group. Do you? Yeah, go for it if you got one.
Perpify everything. I mean, yeah, I mean, perps are a super instrument, right? But like, will they be, will everything become perpified? I mean, it could be. Like, I don't see a good reason why it couldn't.
Sure.
I'm, but is it the most efficient form of leverage? I think it probably is, at least the best one I've seen so far, right? And the simple, how simple it is, this whole margin mechanism, it just scales really, really nicely. I definitely think it can. But like this like phrase perpification of everything has a lot of like implied assumptions, right? In the sense that like okay, if assets have a decent amount of liquidity, then yes, the perp makes total sense. But things that are not inherently liquid themselves, I don't think the perp is going to do anything. Like, you're going to launch a perp on it, and you'll see like all these shit coins that launch that have fucking garbage liquidity, and people like launch perps on them, and they don't work out because and it's not the perp's fault. It's just that these tokens are illiquid and there's less, risk takers. Like, liquidity just means less people to buy and sell on demand, right? So if there's less risk takers, it means it's going to be less liquid. And so putting it on margin, you're putting margin on it, put leverage on it via perp, doesn't really going to do anything about it, right? So you can perpify everything. Does it make sense for everything? Probably not, right? And like, there's far better ways to trade more illiquid assets with leverage, or they can be. So yeah, I think there's, I think there's some nuances there in that statement that first need to be dissected.
Sure. Tristan, you got anything to add? Or?
Yeah, I think the argument for is like the way perps works, like kind of brilliant in that like anything that has like some kind of time series reference price, you can basically launch like, leverage perp market on it, which is pretty cool. Like, I don't know, whatever you could think of that, that has some price reference, you can suddenly, it's kind of like a prediction market at the end of the day. You can kind of build these things. And so it is a derivative. It derives from that price, and you can kind of have this leverage trading on it. The counterpoint to that, I guess, is, you do need an oracle price. So things that, for example, if you're trading Tesla stock in like off market hours, like what is the fair price? Like, yes, there's some off hours stuff. There are other things that like, are very illiquid and don't have like strong spot, reference prices, and launching like a perps, for that would be very hard. There's also the problem that like, for example, for a shitcoin, like it is possible, like despite funding rates being there, like there can be massive dislocations between perps and spot essentially. And so I think we've seen it done very well with liquid assets, and it's possible to do for smaller assets and for like the long tail of stuff and RWAs and all this kind of things. But yeah, I think Anand brings up a good point that like you do fundamentally need liquidity and trading interest to be in there for these things to make sense as well.
Right. Flip, what you want to add anything to that one?
I wouldn't add anything. I think that was it's like some assets I don't necessarily think it's needed for. I feel that.
Yeah, totally. No, great answers, guys. Thanks for dropping those. So yeah, it's like where did I see this comment? Wardy says, "Damn, it's an hour already. Feels like the space just started." I know, because this has been such a fire conversation, and we're all hyped up and feeling bullish, so we love it. So that kind of brings me to my final question. What are the next steps needed for the CEX giants to finally topple? That's a pretty that's a pretty big question for the final question. But how do you guys see this all playing out?
I mean, I'm not going to sugarcoat it. I think it's like things are moving pretty quickly, and like I think the tides are turning, which has been awesome this year. It's the reason why me and Anand are not getting a lot of sleep, because we're just like grinding super hard, just trying to keep up with all the momentum, which has been awesome. But great problem to have, obviously. I still think it's, this is not something that happens overnight, even though it kind of feels like it. I still see things over the period of, many years. Like, sure, we'll have some short-term, perps hype and people kind of like all lose their minds over it. But, big businesses are built over the periods of months and years. And that's kind of the future that we're looking towards. Like Binance, like multi-tens of billions of dollars, like, it has 200 million users. Like we're like so far from that. And it's just very much feels like a very early innings. But yeah, things are on the right track, which is good. I think more of these kind of big market events just create or kind of strengthen the Lindy effect of DeFi. The more that we go through them, it's basically like whatever doesn't kill you makes you stronger. And I think over time, we've already seen this with like Ethereum DeFi. It's been around for so many years, so many different hacks and attacks and whatever it might be. Now it's like pretty damn trustworthy. And I think, some of the platforms are quite solid now and will only continue to get more solid over time. I think the kind of weaker players in the game will come and go, but like the really strong ones that are building for the long term that really have good tech and like good idea how to like operate an exchange properly will continue to survive. So I think like trust is very important. I think being able to build things in like the correct way that's user aligned. I think this has been the big criticism of Binance of like they've done things, I guess, that have not been in the best interest of users. That has definitely like voided trust. And that's something that you can't win back very quickly. That's something that is built over years. And so I think, DeFi continuing to do things well, continuing to stand up against, these kind of adverse market events, continuing to do things that, are in the best interest of users will like continue to win customers. And yeah, like Hyperliquid is probably like 1 million lifetime users. Binance is like 200 million. A lot of other Perp DEXes are still kind of, like sub 100K. So we got a long way to go. And there's like a lot of users that will like funnel across. I think as DeFi becomes more normalized in the more general public, that would be great. Like I still don't see my friends trading on DeFi. Like they know what Bitcoin is. They know what Solana is now after I showed it to them very hard. But yeah, they're still not necessarily like trading on DeFi, like the vast majority. And I think UX is also going to get a lot better, not having to manage wallets in like the clunky way that we've seen in previous years, being able to like connect up and like bridge into these protocols and use them. Like most of these apps, I think on DeFi, like I would say most of like the current generation of Perp exchanges are starting to feel pretty damn good and like on par with centralized exchange UX, which is a big thing, right? If you're a whale and you have a bunch of ETH, you're willing to chew glass and like pay all these gas fees and wait for transactions to clear, within a minute and do all this cross-chain bridging. But for the average user, this is just not going to cut it for them. They're just going to churn straight away because they're like, what is this thing? So I think UX is definitely going to improve a lot, which I think will be great. And then I think the other one's probably like once we start figuring out fiat on-ramps, I think that's still quite a clunky thing. This is what I don't like is like, I remember it was like 2 years ago, I was like hanging out, grabbing a beer with a friend, and he pulls up, he like opens his computer, he's got like Binance there, he's like trading on it. I'm like, why don't you trade on DeFi, man? Like this is what we're all about. And he's like never done it before. And I go to try and onboard him. It's like, oh, you need to install some wallet extension. And then we need to get you like actual like USDC in your account. And it's like, okay, you have to go back to the centralized exchange, on-ramp, do all this it kind of defeats the point. Like they're still having to go through the centralized route. And I don't think like decentralized on-ramps have like fully been solved yet, but it seems like a lot of people are working in that kind of stable coin and fiat on-off ramp space. So once that becomes, I think, really frictionless and plugged straight into DeFi, that's going to be extremely exciting as well.
Definitely, man. Yeah, a lot of comments in the chat here. Self-custody still scary for a lot of folks. User education going to be a big one. Anand, Flip, do you guys have any?
I'd say the next step is back to your earlier question on zero fees. I think that's how you disrupt Binance. Like Binance owns the KOLs. Like they dominate that vertical, and they pay 60 to 90% of those fees back to those affiliates, and they make an incredible amount of money. And so, like, yes, like let's say Bullet says we'll give back 100% of referral fees to the KOL. 100% of a 10 million is a lot less than 90% of 100 million. Like it's a massive difference. The volume that Binance does is like we can't pay these KOLs enough, and so that's why I think it really anchors on like zero fees are so important. If you believe over time people would prefer to use a free venue over one that charges them, I think it makes all the sense in the world, because like how do you take those users from the KOLs and bring the KOLs over? You have to go zero fees, in my opinion. That's how you disrupt Binance. Like yes, you got to work on the UX, you got to work on the on ramp, off ramp. But the next step, I think, is zero fees. I think it's going to be zero spread, zero fees is how you're going to disrupt the Binance and Bybit's KOL machine. I think that's how you do it, and that's why I love what Paradex is doing with the zero fees. And I'm sure Anand's got more to add there.
We need more content destroyers, not content creators. Right? No, exactly. Go ahead, Anand.
That's actually exactly our thesis, that there's customers are being kind of like users are being overcharged only for that value to be leaked away, by the exchanges to these like creators, right? And I'm not saying creators are not needed, but you don't need to overcharge users that much, but and give away. You don't need to charge people 6 bips and then give away 4 to 5 bips to creators who are just basically, they're in a sense it creates this really, a really like adverse relationship between the three entities: the exchange, the creator, and the user, because basically these creators are basically monetizing off their users, right? That's not a good thing for people to know about, that like, oh, they directly profit if they recommend a trade or something like that, right? So we think a better model is, we think creators are very important, right? I think the thread guy has talked about finance and entertainment kind of being like the next meta, right? Or like the meta going forward. I'm a big believer in that. Streaming, I think, is going to have a massive place in the future, specifically for finance, because it kind of taps into the power of like local networks or personal networks. And I think that's very, very powerful. And so so I'm not saying that they're not needed. In fact, I'm saying the exact opposite. They're going to be a bigger part of people's lives in the future. I just think the business model needs to change, and it needs to be more aligned between these three entities. And I think going zero fees and rewarding creators with our token is a much more, because you make them owners of the exchange, right? And that's an owner conversation versus someone just being a broker and taking a charge every time you make a trade, right? So I think switching from being a broker to an owner is where the innovation is, because I still think obviously creators are very, very important. And I think to Trevor's point, that this is one of the last places where we can still punch and it will hurt for the exchanges. And and that's something we can do, even though we're very small, because it's something we can do and move fast and have these very cool innovative business models, right? So that to me is one thing. But like to your other point, I think you brought up earlier that what is going to topple these exchanges. I don't think it's going to be like one thing, right? Like totally. I think Mark Andreessen said famously that like it's never like there's no silver bullet, right? There's only like 100 lead bullets. Like you just gotta keep firing these bullets, and then like over time, that's like the whole gradually, not gradually then suddenly, right? It's just like you keep firing, and then one day, boom, it's like all these 100 bullets that you fired, they just hit all together. Yeah. And I'm a believer in that internally, but also in the context of competition. You just got to keep chipping away at the enemy, and then at some point, boom, they topple.
It's like the great Biggie Smalls said, stay low and keep firing.
Right.
Guys, this has been such a fun.
Confirmed bullet pill with how
many bullets. Right. There we go. Hey,
right. Cool. There you go.
There we go.
We're gonna add on to that. I think like Trevor brought up a really good point that just like the fees make a lot of sense. Like we can't compete with the centralized exchange, KOL, affiliate, marketing budget, slapping their logos on stadiums and F1 cars. Like this is just like not our game. But we can innovate on like the technology is just going to get better. We're going to compress that stack, remove middleman, make things more efficient. That's kind of how we win and provide that better product and like price point. I think is like a big factor for us. And I've kind of already gone through this in like traditional banking. I use my old bank. They ripped me off on like Forex fees. Now I moved to neobanks where it's like much better UX in terms of the app. They're giving me much lower fees. It's like kind of become this like race to the bottom, like much more competitive. They're giving me rebates, all these other benefits. I'm like, this is great. Obviously I'm going to switch, and maybe in the early days, I'll be using a Coinbase and it's convenient for me and I'm happy to pay 60 bips on my spot trades. But like over time, if you gave me a comparably like similar, experience with much lower fees with comparable liquidity, I would definitely, the switching costs would be much lower. And then, liquidity, I think, is the other big thing that needs to kind of improve in DeFi. But like I mentioned before, institutions are looking to get into DeFi like pretty hard at the moment, and already a bunch of them are kind of quoting there. So it's very cool, looking at like Paradigm, what they're doing. And like I saw your dashboard comparing like some of the spreads that you had with some of the bigger players. It's like really cool to start seeing like liquidity is starting to create this kind of black hole of liquidity on chain, and it's composable, and there's so many other benefits as well. These centralized exchanges tend to be walled gardens. So all things are kind of converging in a good direction.
And then I think one piece that DeFi I think we're really going to innovate on is liquidity. Like liquidity is a multi-dimensional surface, and this is something I believe Anand first coined and started doing. Was like a lot of people talk about liquidity being one surface, one dimension. It's a lot more than that, and I think that's one place that DeFi, like us in DeFi, will innovate before the exchanges, and the exchanges will end up copying us. And I think that's part of the punches that'll really hurt is when we've got integrated, we've got our order book, we've got dark pools, we've got RFQ, and all these things like that. That is liquidity. And I know Anand can talk more about that over time.
Don't want to give away our secrets to the centralized exchanges, bro. What are you doing? You're like,
too much alpha. Sorry. I think it's where DeFi is really gonna hit back in a meaningful way.
Yeah, I mean, look, it's a function of innovation, right? It's like you have to find places where you can be better. Liquidity is clearly one of them. Hyperliquid did it with a couple of the cancel priority. We have RPI. Lighter is doing it like slow and fast. I forget, they have these two profiles. So like, where if we find a place that we can be better, you can be sure that we're going to do it, right? And so like, why? Because we only have so many areas where we can beat them because they're so big, they have so much money, they have great customer retention, they have all these nice products. Switching costs for the customer is very high, and so we're going to take every micro edge, little edge place that we can see and find and innovate on that. And liquidity and fees, I think, are the two obvious ones. So it's not surprising that you're seeing most exchanges kind of innovate on these two things, basically.
Definitely, man. Very well said. I'm very, very excited for what's coming, man. You guys got me extremely, extremely bullish over here.
But if you're now 2 times as bullish, then you should be Jimmy 4 times.
4 times, yeah. I know. I gotta change the name now. It's like a whole thing.
Or Jimmy Zero Fees. Or Jimmy.
I gotta change my Twitter. I gotta do it. It's like a whole thing now. So
I like Jimmy Zero Fees. That's a good one.
Jimmy Zero
Jimmy
Fees.
what?
Jimmy Zero Fees.
Oh yeah, Jimmy Zero Fees.
You're gonna do it. You're gonna have to change it eventually. Might as well change it.
I mean, Jimmy Zero Fees. Yeah, that's hot fire. That's hot fire. I think I might have to change that today. Jimmy Zero Fees. Yeah, you guys convinced me. All right. Guys, this has been amazing. I want to thank Tristan, Flip, Fiddy Bips, Anand, and Trevor, aka. Guys, where can we find you online?
Fiddy Bips 1 on Twitter.
I'm Tristan.
Oh, you're on mute, Trevor.
Go ahead, Tristan. You're good.
I said I'm Tristan 0x on Twitter.
I had to look up my Twitter. I'm gonna be honest. Trevor _Flipper. I didn't know it.
All right, and I'm Jimmy 2 times. Actually, I did get the Jimmy 2 times back in the day. There's like several people that have messaged me for that. You're never getting that name, Elon. But I don't tweet about cool stuff like these guys. Anyways, this was amazing, you guys. Thank you so much for joining us. Chat, thank you for joining us. All the great conversation we had in here. We're going to do this again in 2 weeks with more special guests. And be sure to keep an eye on the Bullet Twitter for all the mainnet updates. It's coming, we promise. All right. So guys, thanks again for joining us. We will see you in the next one.